Hey guys, this is Make Dollars and Cents, and today we're going to be talking about options contracts and how they relate to the stock market and your investments. We're going to get started with a little definition on what options contracts are. If we head over to Investopedia, which is a great resource for new investors and anybody actually that wants to learn about finance in general, you can see here an options contract is an agreement between two parties to facilitate a potential transaction on the underlying security at a preset price, referred to as the strike price, prior to the expiration date. I said that quite slowly because all of these things are very important portions of what an options contract is. A potential transaction, meaning that it doesn't have to happen. You have the right but not the obligation to do something on an underlying security. So an options contract derives its value from an underlying security. That's why they're called derivatives contracts or derivatives products. At a preset price, which is referred to as the strike price in the option. This will make a little bit more sense once we take a look at a real example, prior to the expiration date. So you're buying the right to buy or sell 100 shares of the underlying stock at a given date for a given price. So again, if you read through this, just these two paragraphs here over and over again, you might be able to bash it into your brain that way. But I think the best way to learn about options is to take a look at a real live example. So here, just before we go do that, I'll explain there's two types of contracts, put options and call options. So a call option is the right to purchase 100 shares of stock at the strike price prior to the expiration date. So let's take a look at a real live example. We'll pull up Starbucks. I've got Starbucks here in Yahoo Finance. You'll see the market's moving because it's open. We clicked over to the options tab, and you have a few toggles down here that you can pick from. I like to use the straddle because then I can see the calls and puts right next to each other. So you have calls here, puts here. We're going to focus on the calls again. And remember, a call is the right to buy 100 shares of stock at the underlying strike price. So you can see the strikes here right in the middle. And right now, like we saw, Starbucks is trading at 61.53. So we'll go down to 61 and 62.50 strike prices. These are two different options contracts, right? All of these different strikes represent a multitude of different contracts, all expiring on April 3rd, today. So you'll see you can buy at a contract that says, if Starbucks closes above $70, I can buy 100 shares from the person who's on the other side of this trade at 70. Those are only going for a cent right now. Why? Because what's the likelihood that Starbucks is going to close above 70 by the end of today? I mean, it would have to jump up $9, more than 10%. So if we change the expiration date, let's say we'll go out to May 15th. So that's more than a month out. Actually, we'll go to May 1st. That's closer to approximately a month out because it's April 3rd. So if we go to that same options contract, the 70 strike on Starbucks, these are the strike prices here in the middle. That means that we can buy 100 shares of Starbucks at 70 before the expiration date of May 1st. These call options, which are on the left side here, are trading for $1.70. You multiply that by 100 to get the actual price when you go to buy the option. So that would actually cost you $170 to purchase this option. So why would you want to purchase this option? You think that Starbucks is going to go above 70 before May 1st, the expiration date. Let's pull up a chart of Starbucks. Here's Starbucks. I have placed a line here right at, we'll move it to 70 approximately. That's pretty close. And right now we can see Starbucks again is trading around 61.5. And so we think by May 1st, let's put a vertical line at May 1st. Okay. So we think that by this blue line here, which symbolizes May 1st, you can see that down on the bottom of my trading screen of the chart. We think that by May 1st, Starbucks will be above the red line. That's possible. That's perfectly plausible outcome. Could happen. if we did think that, why wouldn't we just buy the underlying stock? Why wouldn't we just buy Starbucks? Well, options contracts give you the ability, but not the obligation to buy 100 shares of stock. So you can make a trade where you're only flipping the contract. You don't ever have to touch the underlying stock of Starbucks. So instead of spending $6,000, whatever it would be, to buy 100 shares of Starbucks, you can just buy this option contract here for $170. And that will give you the exposure to Starbucks' stock for a fraction of the price. You're paying $170 versus $6,000 for that option. Now, there's benefits to this and there are drawbacks to this, right? You're putting down a lot less money. So there's a factor of leverage, right? You don't have to put down $6,000 to control 100 shares. You're putting down $170 to control 100 shares of Starbucks stock. That cuts both ways, right? Because if you're wrong and Starbucks never goes above 70 before this vertical line here, before May 1st, your contract expires worthless. You lose all of your $170. However, if you were to buy the stock, you would have spent the $6,000, so you would have invested that $6,000, and if it went up to $68.50, you would be in profit. You'd have made more money, right? Starbucks also pays a dividend, as you can see here, so you'd be collecting dividend checks along the way, potentially. With an options contract, you don't get any of that. It's just, is the market price above the strike price at the time of expiration? That's it. If that is not true, or if that is not close to being true before the option expires, you lose everything. Now, I hedged what I said there, close to being true before expiration, right? That's because the value of this option is not solely tied to the price of the underlying stock. It derives most of its value from that being in the money or out of the money. In the money would mean that Starbucks was trading above our 70 strike price. Out of the money is right now, right? So Starbucks is trading at 61.70 now, market's moving, and it's still not above 70. So that means that this options contract here on Yahoo Finance is still out of the money. And actually, Yahoo Finance has a pretty cool little shading feature where it shades the in-the-money contracts blue, and that makes sense, right? Currently, Starbucks is above 61, therefore this contract is in the money. On the put side, it's exactly the opposite, right? So you can see that the shading ends at the same exact spot. For a put to be in the money, the stock price has to be below the strike price. So if we go here, back to Yahoo Finance, we see that currently Starbucks is at 61.91. It is not below 61. Therefore, this contract here is out of the money. That's why it's shaded in white. 62.50, however, is in the money because currently Starbucks is trading below 62.50 for a put. 62.50 is out of the money for a call because for a call option, if we go back to the graph, it would have to be above. So if you talk through this to yourself and you play it out this way and you look back at the options chain, which is what this is called, the options chain, it'll start to make sense, right? And just by looking at how over here is shaded white and over here is shaded white. So that means that these are out of the money. Blue means in the money over here and over here. So just looking at these a couple times, tying that into this example, which I'll link down in the description below, as well as looking at the chart, we'll tie it all together for you. And it comes with practice, right? Nothing like this comes in one day. But if you rewatch the video, get some practice on your own time, you'll start to get the hang of it. So why are options so attractive? I think that the payoff with the minimum amount of risk, minimum amount of money that you have to put down is attractive to most people. Also, you can get kind of creative, right? Because you don't just have to buy, you don't just have to be the buyer. You can also be the seller. So I could be the person selling you the option over here for $170, right? Because I don't think that Starbucks is going to be able to reach $70 by May 1st. I'm not saying that as a fact. I'm just using it as an example. You know, there are buyers and sellers on every side of every trade, right? So if you're buying this call option from me, I'm selling it to you. So you're spending the $170. I'm receiving it as a credit, right? So what does that mean for me as the seller? That means that if you want to buy Starbucks stock at $70, 100 shares of Starbucks stock at $70, I have to sell you 100 shares of Starbucks at $70. Let's look at a payoff diagram and compare those two things, right? Here is a very important profit picture for each of the different sides of puts and calls, right? So like we're talking about now is a long call. A long call is where you just buy a call option and hold it, and as the stock price moves, your payoff moves. And all these graphs are the same. Stock price is on the x-axis, payoff is on the y-axis. And you can see that as the stock price moves, where K is the strike, as it moves past the strike, you make more profit. That's that simple. K here just symbolizes the strike price of the options contract. So we'll call this 70, and we'll pretend that the stock is Starbucks, right? So as Starbucks stock moves up and hits 70, you start to make profit on your options contract. Myself, as the seller of that options contract to you, as the stock hits 70, I start to lose money. And you can see that I can start losing an infinite amount of money. And you can make an infinite amount of money. So this is a very risky proposition, right? Selling contracts to somebody where you have to sell them a contract for 70, and the stock might be trading at 100 or 150. I'd have to buy that stock at 150 and then sell it to you at 70. So I'm taking the difference as a loss. If you think about that, put it in an Excel file, work through the math, it makes perfect sense. I would have to sell you the stock at $70, right? And I would have to go buy it at 150. I'm going out to the market, I'm spending $150 for the shares, and then I'm immediately taking basically a 50% loss on my trade and selling them to you for 70. That's not good. And all I got in return was the $170 premium at the beginning of the trade when we put it on. You gave me $170 to put on your call option. I promised you that if you wanted to buy 100 shares of Starbucks at 70, I would do it for you. So as soon as Starbucks jumps up, let's say it jumps back up to 100 where it was, looks like in 2019, if Starbucks jumps all the way up to 100 before May 1st, which is, highly unlikely, but nothing is impossible. If that happens, I then have to go to the market, buy 100 shares at $100 and sell them to you for 70 because you bought the right to be able to do that. So if you look at this profit diagram, it's the same exact thing for a put. It's just flipped the other way, right? Because when you buy a put, you want the stock price to go down. Let's look at gold, GLD. So gold, as the coronavirus pandemic has played out, has kind of stayed relatively stable here. This is an ETF, a ticker GLD, and we think that gold has been relatively stable, but maybe the recovery is around the corner, and we think that gold might fall as people look to buy stocks. So they're going to sell safe investments like gold and bonds, and they're going to buy more risky investments like stocks. That would push down the price of gold and push up the price of stocks. So how do we profit from the price of gold going down? Well, as you saw here, we could buy a put option. Let's go over to Yahoo Finance. We'll type in GLD. This is all just hypothetical, by the way. Gold, all right, currently trading at 152. Let's pull up the options chain. Like I said, we'll use the straddle. And we'll change this to May 1st again. Let it reload. And like we said, gold is currently trading around 150, so we'll go down there where we see the in the money and out of the money happening here. We want to bet that gold is going to go down. So what are we going to do? We're going to buy a put because puts give you the right but not the obligation to sell 100 shares of gold ETF at the strike price. So what does that look like? We get to sell here at the strike price, even if the price of gold goes down further, right? So let's think about this. If currently gold is trading at 150 and we buy an option that gives us the right to sell it at, let's see, it's trading at 150, so let's go for 140, right? So if we buy this put option here that gives us the right to sell 100 shares of this ETF at 140 in a month, that means that if in a month it goes down, pull up the chart, here's 140 approximately. We'll put a line. We'll use May 1st again. Boom. We'll grab a horizontal line. And we'll put it at 140 approximately. So we think that we're going to start recovering. Safe assets are going to fall. And we want to profit from that. So we think that gold is going to go below 140 by May 1st. That options contract is right here. Put expiring on May 1st for 140. And that's going to cost us $74, right? So this says 74 cents, but we have to remember to multiply that by 100 because we get to control 100 shares of the ETF, right? So when you actually go to buy this options contract, it's going to cost you $74, not 74 cents. Let's look at the payoff. If gold goes below the strike price, we start to profit. Our payoff goes up. That means that if it goes below 140, we can still sell it at 140, even though the price may be 120. If gold goes down to 120 by the expiration date, again, unlikely, but nothing is impossible. If it goes all the way down to 120, we get to sell it here at 140 and then buy it back immediately at 120. Buy low, sell high. That's the whole name of the game here. So we are selling here, buying here. We profit the difference. That spread of $20. So we just made $20 times 100 shares of stock. $2,000 on our $74 that we just laid out. That is why options are so appealing to some people, because you can make massive amounts of money on very, very little money down, and that's the point of leverage. You can also lose every cent that you trade in this option. If gold never goes down to 140 before the strike price, it is 100% worthless to have that options contract. It's like a concert ticket. After the day of the concert, they're 100% worthless unless you want to keep around a memento, and not many people want to keep around random concert tickets as mementos. That is the general gist of options contracts. I hope that this was helpful for you. I hope that this wasn't too confusing. If it was, please leave your comments and questions down below. I will get to them. I will answer them 100%. Check out the website at makedollarsandcents.com for written content if you're into that sort of thing. I hope you enjoyed the video, and if you did, please consider leaving a like and subscribing here for more content in the future. I do hope to be posting here more regularly from now on. Thanks again for watching, and I'll talk to you soon.